Good morning, good afternoon, good evening. How are you guys doing? Adrian, Chase, Peter, how you have been in the last couple of weeks?
I mean, Bitcoin's been doing pretty bad in Bitcoin treasury companies, but at least the AI trade is live and strong.
Really cool.
I'm doing well. I can't complain. I'm in the AI trade, so things are good.
Yeah, and I basically feel nothing when I look at Bitcoin price these days, which I don't know if is a good or a bad thing at this point.
That's a good thing. That's a good thing.
It is a very good thing, but I don't know. Like I feel a little bit of like, oh shit, I should have kept more cash because I want to buy right now. But that's the only feeling I usually get. We talked before. It kind of organically came up the conversation about how we allocated to AI, also how we allocated to Bitcoin and treasury companies. How do you guys feel about having the AI trade? I think, Peter, you were talking about it being a little bit overheated. And then I think we were talking about, is it overheated? Is it a bubble, or is it just a paradigm shift? Maybe Peter, give us some of your thoughts to the difference between what you see in Bitcoin and the overall market.
Yeah, I don't know if it's overheated per se, because I agree with what Adrian says, which is we're in a paradigm shift. And the way you can tell by that is you actually look at the PE ratios of these companies. Yes, are these companies, growing by 20 billion market cap in a day, and a lot of them are hitting the $1 trillion market cap, seemingly like every other day? Yeah, there is. But what you see is that unlike other bubbles where the multiple expansion is effectively the PE ratio, where the price or the PE or the price of the stock is accelerating at a faster rate than earnings. We do not see that in this. Matter of fact, it's actually the inverse, where the earnings are actually outpacing that of the price, which you for certain companies, there's actually a multiple compression despite a huge absolute return. And so, is it a bit scary? Yes, in the regards that there's a higher and higher concentration of these ultra profitable, ultra high growth companies, while everything else is being lagged behind. That's what I'm concerned about. And also, I'm concerned about that effectively this is hardware and semiconductors and energy and memory chips, which are very location dependent. There's a great book called Chip Wars, which kind of lays out how interconnected these semiconductor and effectively this AI trade is across the globe. And so, yeah, if there's any real serious geopolitical risk, and mostly I'm talking about Taiwan issue with China, it could have really catastrophic effects.
Interesting. And Adrian, you were talking about that you think long term it will be fine, and that you were also like not surprised, but like you had some AI trade going on that like kind of hedging you right now against the Bitcoin trade that you're doing.
Yeah. So with Peter's point, the risk that people do talk about with regards to what can really destabilize it, I call it, the red swan in the case of China and Taiwan. So that is an event that can really destabilize this entire thing globally. But also, and I'm not trying to be a doomer here, if China were to make an overtly aggressive move towards Taiwan, we can spiral into World War III very, very easily as a result. So that, I think, it is a outlier in the sense of, do I think we're going to see Chinese troops on the ground in Taiwan taking over infrastructure? No. Do I think we're going to see prolonged and more deliberate acts of overt aggression towards Taiwan? Perhaps. But I also think there's a lot of incentive for China to mitigate that and find a peaceful solution. So that aside, coming to your point, because Peter raised a very, very good point, what is ironic about the AI trade is that I got into NVIDIA and MSTR at the same time in 2022. And because of NVIDIA, I've been systematically expanding my allocation into other aspects of the AI trade. And I've been very vocal about that on X. I've talked about, Bitcoin miners. I was never bullish on Bitcoin mining. I was bullish on the HPC AI aspect of it. I've been talking about the cross benefits of how mining would grow into more of an HPC AI play, and that's why I was heavily allocated in 24 and early 25. I've also been allocated towards Micron earlier this year, towards a few other plays earlier this year. It has ironically become larger proportionally compared to my Bitcoin holdings, which I never thought would have happened. But because of the growth we've seen, it has. So my cost basis for Bitcoin is low, relatively. My cost basis for MSTR compared to where it is low. So I'm very much still in a capital preservation aspect when it comes to Bitcoin and whatnot. I'm not selling any of my spot Bitcoin. I've sold in and out of IBIT, but the AI trade and me allocating more capital towards it has been very, very, very beneficial. And I've been watching it in terms of not the meme-like quality of it. I've been talking about how it should grow out, and I talked about memory like months ago, and I talked about memory last month, and now everyone is seeing, oh my God, memory. So these things are very, very real paradigm shifts in the sense of people keep calling it for a bubble, but a lot of what Peter pointed out, we're not seeing blown out valuations. We are seeing real earnings, and what we're seeing is the market trying to forward model towards what the market thinks the market cap will or should or could be. And that's why we saw Micron go from under 100 billion to over $1 trillion. That's why, people also forget SanDisk, they're over $1 trillion. NVIDIA's over 5. Google crossed 5, and they're now just under 5 at 4.6 or something. All of Max 7's over $1 trillion, or multiples of $1 trillion. You got the SpaceX IPO coming that's going to be over $1 trillion. You maybe have OpenAI and Anthropic that can be over $1 trillion. The numbers are so large, not necessarily because of a bubble, but because I think people see that this is a fundamental opportunity to position themselves for the future. It's not like the AI, the internet bubble, where every company had a website, but they didn't know what to do with it. Right now, the more compute you build out, usage is not going down, it's going up. They're behind it. And the reason why the memory trade is so huge right now is that GPUs were the thing. Compute was the main driver of the initial growth. Memory actually saw a massive downturn because they developed and they didn't have enough demand for the capacity. Now they have demand that ate up their original capacity, and now they have to build up to meet the demand. So you have two things going on right now. The valuation is catching up to what they already could have accounted for, and now the market is trying to project what they will build into. And this is all coalescing into making the AI trade, people are calling it, circular, but it's reflexive. As NVIDIA grows, the others are going to grow. As the others grow, NVIDIA is going to grow. As NVIDIA and memory grows, so OpenAI and Anthropic and all these other companies will have impetus to grow. It's a very, very reflexive cycle, not circular. So I think that's why it just keeps going.
Yeah, the another thing that we mentioned before this call is the fact that because of these mega trillion-dollar IPOs, as you mentioned, it's SpaceX, OpenAI, and Anthropic. SpaceX for sure. We don't know if OpenAI or Anthropic is going to go through. That's going to, that's potentially a lot of liquidity that needs to come from somewhere, right? And so if people are sitting on massive bags like you are from the AI trade, and I know you're not stupid enough to try to ape into SpaceX, for example.
I'm not touching it.
No, I'm not either. But regardless of these trillion-dollar IPOs, if you actually look at the history of stocks that have IPO'd, they've actually pretty much often signal a local market top. You can, the latest one that I remember, I believe, was Facebook, and they fell really flat on their face in the first year, from what I remember. But of course, they've recovered significantly. So that's, while I'm not personally worried about the valuation part of these AI trades, I am worried about this liquidity drain that can potentially destabilize the market simply because the market is propped up by, probably call it 10 to 20 companies, really.
Yeah, and that's something I posted about too. I think that SpaceX is going to be the impetus or the catalyst for a near-term top, and a lot of people are saying it, and people are trying to poo-poo it, but the sheer size of this IPO is unlike anything we've ever seen, and like you just said, it's going to suck and siphon away capital from everywhere. And the thing about it is that because the market's being propped up, we have two things that can happen. Is it just going to be a shift in the sense of, okay, it's going to get sucked out of Mag 7 and the 10 to 15 associated companies and go into SpaceX? Or is it going to siphon away capital from Mag 7 and those 10 to 15 companies, and it's going to siphon capital from other things as well, causing a broader sell-off of everything concentrating into SpaceX? And also, because of the size of the IPO, a lot of funds, a lot of allocations are going to be forced into it just by sheer volume and their mandates. So SpaceX is going to act like a siphon of capital. And to Peter's point, I think it could destabilize the market, but I'm not sure if it's going to destabilize the AI trade. I think it could destabilize everything else. And the capital is going to be sucked in, and then you're going to have a lot of companies that are floundering, that are losing money because their investors are perhaps chasing SpaceX after their investors probably were chasing the AI trade. So, there's just a lot of things that can coalesce. And the AI trade, I don't just think it's speculative chasing. I also think it's because a lot of companies out there are crap, and we don't really need them. We don't need companies that are popping up left and right, providing no value. I don't think the market is harmed if there's a culling of sorts where, longer term, I mean, not short term, if there's a culling of sorts where companies that were just treading water. So like Saylor talks about zombie companies, if they don't go into Bitcoin treasuries, and if they can't, Bitcoin treasury, they can't pivot into digital credit, and they can't pivot into AI, you have a lot of zombie companies right now that are profitable, but they're not really growing. They're just kind of treading water. And unless they find a way to mitigate that, I can see a broader market contraction and concentration where SpaceX can definitely serve as a near-term top.
Do you?
Oh, sorry, go.
Yeah, I was just going to ask, do you see a way where these AI companies that are attracting all this capital and this liquidity, is there an obvious way that the AI trade eventually finds its way into Bitcoin, or is that not so obvious right now, how that over the near or long term, that capital finds its way into the Bitcoin network?
I think they're two entirely different investment theses, and I don't think they're compatible whatsoever. So a lot of people say that there should be a rotation from the AI trade to Bitcoin, right? Just like they say there should be a rotation from gold to Bitcoin. If you actually look at the data and really model it out, like really rigorously, there's no evidence of rotation. There's evidence of cyclicality, sure, but there's no hard evidence saying that this rotates into that when it comes to Bitcoin. Bitcoin is very, very liquidity driven. Bitcoin is very, very narrative driven, more so than liquidity. So I think what's going to drive Bitcoin is going to be adoption, it's going to be narrative, and it's going to be liquidity. In terms of the AI trade rotating into Bitcoin, what is the impetus for that rotation? So they take the capital out of the AI trade, they're up big. So right, let's say you are someone like me, but much, much larger, or someone that's been even longer than me that has profits from the AI trade, and they want to take those profits out. What is the reason why you would rotate into Bitcoin, besides already being a Bitcoin believer? Because that's something I would do. I would rotate capital into Bitcoin because I've been in Bitcoin for well over a decade now. But the broader market is not going to do that, I don't think. I don't think go ahead.
I guess what I'm getting at, though, is not so much the folks who are holding AI stocks trading out of their AI stock into Bitcoin, but is the rapid growth of investment in AI infrastructure and everything related to AI, does that eventually find its way into Bitcoin? Because, some would argue that the money of choice of future AI agents is going to be Bitcoin, and that might be the way that we start to see the growth of AI reflect in Bitcoin adoption and Bitcoin price. But it's very hard to see how AI isn't just purely pulling away liquidity from what might have been Bitcoin's moment in the sun. Because as you said, Bitcoin is kind of this great absorber of liquidity. But if all that liquidity is chasing at the AI trade, then it's not surprising that we're seeing Bitcoin where it's at right now.
Well,
Yeah.
so let's differentiate that. AI is sucking in capital from everything, right? So Bitcoin is just part of what the capital is being taken out of. If you take a look at the whole market, the AI trade has sucked in capital from everywhere, right? So in terms of liquidity by itself is not enough to drive a trade. So liquidity creates the impetus. The liquidity creates the capital that you need for going into the market, but sentiment and narrative is what creates the impetus for positioning. There's nothing that's going to drive, in my view, I could be wrong, that's going to drive a narrative that says, okay, Bitcoin now needs to get some of this liquidity, that Bitcoin now starts to get some of this attention. There's nothing there at the moment, in my opinion. That doesn't mean Bitcoin is bad. Bitcoin is going to fail. Anyone watching this, that's not what I'm saying. What I'm just saying is, if you take a look at what Bitcoin is, it is a monetary asset. Monetary assets are driven by entirely different things than technological revolutions. Bitcoin has been a technological revolution in the sense that it is a technology. But if you really parse that out, it hasn't been revolutionary enough because we still don't have the rails built on top of Bitcoin to facilitate payments globally. The Lightning Network is nowhere near as big as it should be. Liquid for corporations isn't as big as it should be. There are a lot of things that say that Bitcoin has been a revolution, but it's been a monetary revolution. And that is fundamentally different narratively and conceptually than the AI revolution. And that's why I don't think that there's going to be a lot of capital chasing or leaving AI and rotating into Bitcoin. Will Bitcoin see some capital? Yes, but I don't think it's going to be a result of people going from AI to Bitcoin.
There is, do you guys for sure know this picture of 1900s to like 1913, where you show the one picture on the right side where there's like one horse and there's one car and a bunch of horses on the street, and on the other picture there's like the other way around. There's a bunch of cars and one horse in the picture. And I actually looked at that development of the car and how it actually got there. And the car was already around before. It was not that the car was invented in the 1900s. The car, I think the first one with Benz was there, and I think 1886 was the first one launching. It was a messy car. It was a slow car. It was not ranging very far. Had a lot of problems. Like, it was only 16 kilometers per hour. I mean, just a couple of months ago, a human being ran 42 kilometers on an average of 21 kilometers per hour. So like a lot faster than that. But what actually drove, to Adrian's point, what actually drove from like 1% adoption to like whatever 80, 90% adoption in that specific picture was that the roads were paved, that gas station was built, and the infrastructure around the car actually got built out. And so when we think about the Bitcoin infrastructure, the Bitcoin ecosystem, there's like the core, which kind of stayed the same. We have the rules, the consensus around Bitcoin. We have the miners. We have the nodes. Those get bigger or get more people involved in them. But roughly, it's still the same system running since 16 years, roughly speaking. The same with the car. Like, the car got also faster in the first 15 years. It got two-seaters. Like, there were cars with like a roof on top. The first ones didn't have. The first one had 3 tires. Then on 15 years later, I already had 4 tires. but then the actual point where it decides how things get actually adopted and how things actually like grow, I think is more about the ecosystem. And now with treasury companies and with the Lightning layer, like I think we're just seeing the start of that. I think this is what really will drive mass. I think the whole UI and UX of Bitcoin sucks. Like if I want to speak it like so clearly, it's like people need a lot of services, need a lot of education to get into Bitcoin because it's just complicated. Like the whole custody of it and everything, it's not easy. And so I think we have a lot of work to do in the Bitcoin ecosystem. That's my point.
That's where I think digital credit is that iPhone moment for a lot of traditional finance people as they start to learn more about it, right? Because you're right. I completely agree with you. I think Bitcoin always had a marketing issue. Everybody has to spend a couple hundred hours to really wrap their heads around Bitcoin. But if you have something like a digital credit where it's just saying, hey, like I'm paying you a certain yield for you to buy Bitcoin, and then I don't need to worry about it, but I get that yield. That's like a kind of an aha moment that I don't think a lot of people fully appreciate just yet.
Yeah, if we're going to stick with that analogy, you can almost think about, a Bitcoiner that self-custodies Bitcoin as like an early car mechanic that just loves to fiddle around and understand what's under the hood. And the people that are interested in buying digital credit right now is people who are just hailing a taxi cab and have no idea how the car is, actually getting them from A to B.
That's actually valid because a lot of the people so in my local area, I've had a few people have noticed me from being on True North, and they've asked me about digital credit, and they own small companies, and they've expressed interest in having an allocation towards Stretch or SATA on as a company allocation. What's funny about it is that they don't care about Bitcoin, like at all. They don't have any interest in it whatsoever. All they are interested in is, will this offering pay me the dividend in perpetuity for as long as I hold it? Period, point blank. And when I try to get into them, well, it's backed by Bitcoin, they're like, yeah, I don't really care. Essentially, they think it's great that they're assets that are, and this is another thing, backed by Bitcoin. I think is problematic phrasing. I say supported by Bitcoin, in the sense that they can sell Bitcoin to pay the dividends if they have to. So that's how I explain it. I say they have a massive war chest of this asset that they can sell off if they have to pay the dividend in perpetuity, and near term, there are no what I think are existential risks to it. And once they hear that, they become more open to it, and they're just really interested in digital credit, and they're interested in the dividend. They don't seem to care much about learning about Bitcoin. So to Chase's point, yeah, I'm the guy that was screwing around in the engine trying to learn things the hard way, while people now are just going to be hailing the taxi because the car works. They don't care how it works. They just care that it takes them from point A to point B.
Yeah. I that is a good analogy. And I actually think SATA and Stretch and future digital credit instruments are going to be much better for corporations, for charities, right? Because a lot of businesses need to manage their treasuries and their cash flow, right? So if you have something, especially like a SATA that gives you daily dividends, right? And then those, so theoretically they should fluctuate way less because of that. So you have something that's closer to par, but giving you a very consistent yield. That's going to be very useful for a business, as opposed to, trying to orange pill them a business to hold Bitcoin on their balance sheet, where the volatility is really going to make a lot of people, sick if they don't do that 250 to 500 hours of requisite studying.
And yeah, that's something I think is very, very valid. I think the future of digital credit is individual and corporate. It's not institutional. And that may make a few people upset, but here's kind of why I think that. If you take a look at SATA, the daily dividend, why would that be interesting to an institution? Institutions are fundamentally interested in predictable returns, which SATA as a scales will have, but they're not typically going to have individuals in there that need a daily dividend to live off of. The reason why SATA is so powerful for retail is that, if you are an everyday person, putting some cash into something that's going to give you a daily dividend That's huge. That's everything from your burrito to a tank of gas, maybe, right?
Right.
So that's something that's a very, very powerful unlock. And from a corporate standpoint, just like Peter said, I think that they are very, very powerful from a corporate treasury management, from a corporate financial management standpoint, where the corporation can put cash that would be otherwise idle, make it productive, have it generate revenue or dividends, and that will be revenue that the corporation can then leverage. And I think the only other layer of friction that remains is the settlement layer. So what I mean by that is, as it stands right now, when I get my dividend in Fidelity or in Robinhood or Schwab, I have to then transfer it to my bank. Or I can leave it in Schwab and do a reinvest, right, or Fidelity and do a reinvest, or just keep it in either one and have it eventually swept into the money market accounts that they always put your money in, right? So those are pretty much my options, unless I actively reinvest it into other equities. Once that layer of friction dissipates, I think it becomes far more powerful. And I think Robinhood was already talking about something like that, giving you the ability to directly deposit your dividend into your checking account. Once that final layer of friction ends, and it's not really a layer of friction if you think about it, it's just about convenience and speed. I think that's very, very powerful in the sense of, if you are a small business, big business, whatever, you have your digital credit allocation, the dividend payment goes directly into your corporate account and it's instantly usable. You don't need another fiduciary step to say, now controller must go do this, and so on and so forth. It just makes it far more seamless. So I do think that the individual and corporate adoption of digital credit will be huge. Do I think institutional investment growth is coming? Yes. But I think institutions will be partners in digital credits more readily than they will be allocators towards digital credit.
What do you guys think is the split between, I mean, now it's like 80-20, I think, but like, what is the future split between retail and businesses? I feel like retail,
For digital credit?
Yeah, for digital credit.
If I had to take a guess, I'll say 10% institutions, 70% retail, 20% corporate, or 10% institutions, 60% retail, 30% corporate. That would be my guess.
Yeah, I'd probably come in around there too, because I'm looking at, like, I was gonna maybe mention this, but my dad is looking to retire, call it 1.5 million of capital. We're talking about SEDA, and I see so many people of his generation who have been trying to make, their retirement income through real estate, rent, in jurisdictions that are punishing Airbnbs or high tax jurisdictions. And we're at the point now where it's like, screw it, sell the house, load it into SEDA or STRC, and collect your dividend, and check it out on Robinhood, and forget about all the headaches associated with it. And I just see that becoming a much faster growing trend and a much bigger source of capital than even treasuries. I think companies tend to want to reinvest, and they have a bias towards reinvesting in their own product lines, even if it's maybe not necessarily the best use of capital. They always have this belief that, the next thing the customer asks for, that they can build, and it'll increase the enterprise value more than just buying STRC or SEDA for the balance sheet. So there will be adopters of digital credit on the corporate balance sheet, but not in the way that I think we're going to see the baby boomer generation adopt this asset.
And even Gen X and Gen Z and millennials, I have people that are younger than me right now by a good 10, 15 years talking about digital credit and talking about dividend payments. That would never have happened without these offerings, because younger people, they don't really think about that, right? They think about, yeah, I'm going to be in the market, it's great, but they don't think long term about, hey, if I put this 10 grand here, this 15 grand here, it's going to give me a perpetual extra bit of income that I can do whatever with.
I think the world that we're entering, where inflation is going to creep up more and more, is going to make people want to supplement their incomes, right? I mean, that's why there's such a side hustle kind of culture that we have amongst millennials and Gen Zs. And on another note, I really like how you broke out the institutions versus the corporates, Adrian, because I completely agree with you that I can see corporates, outpacing institutions 3-1, 4-1, simply because, when I did investor relations at an S&P 500 company, I sat across the way from the treasury guy and also the FP&A team. And there's a reason why those treasury departments do not invest in high growth, high volatility assets. That's because they need predictable cash flow. And so, in a scenario where you have high predictable cash flow that has strong yield, I can see corporations, once they get their head around this, to really want to implement this into the business.
Let me, Adrian, I kind of mentioned this to you on the side a few days ago, but let me kind of hear what you guys think is the downside of what you might call like the digital credit carry trade, where people can go on Robinhood and borrow at, call it 4% and plug it into something like SEDA getting 13%. And obviously with daily dividends, there's low risk in terms of, will that money be there in time for my next, margin payment? How do you guys think about this? Is this going to create a large carry trade? Is it as risky as other carry trades that we've seen in the past? Or is this perhaps maybe an interesting thing that even a normie Bitcoiner or normie digital credit holder should be looking at?
Well, on the surface, it makes sense. You borrow at 4, you get 13, you keep the spread, right? Fairly straightforward. The one immediate risk I can call out is I don't know if you guys recall, when Robinhood first put the preferreds on, they were at 25% margin, then they kicked it up to 50, then they kicked it up to like 75, then back down to 50. And a lot of people got caught off sides very, very quickly on margin calls. Now, that was a very, very brief thing. But what if there is a market event that changes the margin requirements and now you're caught off sides? So that's one thing to consider. In terms of other risk vectors, I'm not a person that thinks that these are guarantees to succeed and they cannot fail. Do I think they will succeed? Yes. However, we still need to be cognizant of the fact that these digital credit instruments are incredibly new. They are tethered conceptually, practically towards Bitcoin and towards operating companies. If Bitcoin falters and operating companies falter, they're going to falter as well, regardless of the fact that they pay a dividend. Because I'm not saying that is valid or that should be the case. I'm just saying that, that is my view, and I think it's borne out by evidence that markets move on sentiment and perception, right? So if there is a perceived weakness in Bitcoin and thus a perceived weakness in a parent company, that is going to cascade into the preferred offerings and may cause some near-term stress. Now, does that matter as long as the dividend is paid? Not so much. But the other risk vector I will talk about is people need to understand that Strategy, Strive, they are not necessarily obligated to pay out the dividends as they say. They're supposed to be paid out cumulatively if all else fails. So they can, in theory, pause the dividend payments for X amount of months, weeks, days, as long as they pay them out cumulatively over time. Do I think they will do that? No, because at any point, in my view, in now to the next 5 years, if they even stop the dividend payment once, they're dead. I think the preferred offering is dead. It is dead on arrival. They will never recover from it, specifically because of the risk profile of the parent company and of Bitcoin. It is not as if this is Chase. It is not as if this is some massive fund. We need to accept the fact that we are still early adopters, even though it seems crazy with Bitcoin being over $1 trillion and there being digital credits and Rails being built on top of digital credit. We are still early adopters. So any kind of stress in the system will have disproportionate impact in terms of how the market reacts to it. Now, all those risks aside, what you're proposing, it does make sense. I can see why people will do it as a carry trade to pocket the spread. I think there's people doing it right now. I've already been approached by Fidelity because I have open conversations with a few people to borrow against my stretch and my SEDA because of the size of my allocation. Not for a carry trade, but just to borrow against it. So I think borrowing against these digital instruments is going to become far more commonplace. So what you're saying, risks understood. makes sense depending on your potential investor profile.
Adrian, quick question. Did you mean the risk for an individual doing the carry trade, or do you mean that the carry trade might pose a risk long term for the digital credit itself because people are leveraging up and the whole thing kind of has too much pressure on it?
No, I mean for the individual, not for the digital credit instrument itself. And because check my logic here, if we think about it, if someone owns $1 million in Stretch and they borrow against it, and they then use that to borrow more Stretch, or if someone has $1 million in cash and they borrow against it, put it in Stretch and keep the difference, those are two different things. So I apologize if I wasn't clear in that. We're talking about borrowing cash to borrow the digital credits and to keep the spread between the two with regards to what you're paying in interest. That's the carry trade. So I apologize if I wasn't clear in saying that it was borrowing against Stretch or SATA.
I mean, we talked about this, I believe, last time, where it's like, right now, let's just use, I think, MSTR, for example. Every time you ATM Stretch, you also should technically be ATMing MSTR, not exactly like all the time 1-to-1, but roughly 2-to-1 over time to maintain an amplification ratio. But if there is a black swan event where Bitcoin's price gets cut in half, your MNAV at the common shareholder level also gets cut in half. Okay, but then this is also why it's important to look at something like the CEB metric, which is the common equity Bitcoin exposure, right? Which is, what do you own as a common shareholder? Well, you own what's left after the debt and the preferred is paid out. So in that scenario where your NAV gets cut in half, but then now you've, during this run up, during the bull market or even the grind up, you're ATMing the heck out of both Stretch and MSTR. Then you're they call it drag, which means like effectively the percentage of the preferreds and debts ownership relative to you as a common shareholder increases significantly. So that could potentially cause a lot of narrative issues where the commons are like really, really squished for a long time, while the preferreds are still needing to be paid out. So you have to remember, at the end of the day, this is a perpetual vehicle that is not cheap, right? SATA is paying 13%, Stretch is paying 11.5% into perpetuity. So if you look at the 5-year CAGR of Bitcoin, like over this current 5 years, it's not 30%, And so again, everyone likes to say that Bitcoin is going to be a 30 AR, 30 volt asset, for the next 10 to 20 years. That's not a law of physics or mathematics. It's just an assumption. So that is the risk that you're also running against as well.
So, and the one thing I will say about the breakdown is that I think people are being far too generous assuming Bitcoin's returns, right? It's over time, and this is something that people just don't, I think people understand it, but they don't really think about it. Over time does not mean over time frames. So it's not going to be every year 30%. It's going to be over time, it'll be 30%. So let's say 5 years, you can have 2 or 3 years that are disasters but 2 years that are massively successful. So people need to add that into their risk assessment in terms of what they're prepared to tolerate. And here's my issue with a lot of these models and trackers, though, whether it's CBE or something else. So if we take CBE or CEBE, the problem with that methodology is that the preferreds can't act as a drag on anything because the preferreds are directly feeding the net asset value of the company, which is directly feeding the common shareholder. So something can't be a growth engine on one end, but a drag on the other. It's actually kind of circular in that way. So I think that's why the CB tracker is useful as a understanding of corporate structure in terms of how the preferreds stack up. But that's why I really was specific in talking about liquidity preference versus seniority. The preferreds are senior in a liquidity preference, but they're not senior in the claims to the Bitcoin. Those are two different things. And from a risk assessment, there are two different things as well, because functionally, in a liquidation event, you're getting fiat, you're not getting Bitcoin. So anything Bitcoin denominated or Bitcoin focused, I think, is only seeing half of the equation in terms of what the risk assessment is. The market can rate Bitcoin much, much lower in a liquidation event than we think, if that were to happen. So those are just things that I like to think about in terms of risk assessment. But to Peter's point, it's not a law of physics that Bitcoin is going to be 10, 15, 20, 30, whatever CAGR year over year. It's over time. And that's definitely something that needs to be considered when people are doing their risk assessment for these kinds of instruments.
Let me double click on that, Adrian. I don't have a strong opinion on CEBE, but you're saying STRC issuance can't simultaneously be a growth engine and a drag. But isn't STRC just leverage? And if the leverage works against you because the asset that you're levering up to buy works against you, then it could be a drag or it could be a growth engine. Isn't that just based on whether or not Bitcoin performs based on the assumed growth rate, that it would be a growth engine or a drag?
Well, that's because of Bitcoin, not because of the instrument.
Right.
So the drag in that example, if I'm understanding it correctly, in my view, in my understanding, drag would be that issuing preferreds and the preferreds on the balance sheets are acting as a drag on the common equity performance, or acting as a drag on the overall corporate structure in terms of their outstanding obligations. But that's why they are debt-like, but they're not debt. They're debt-like because of the fact that they're not perpetually mandated to pay out the dividends. They can pay them out cumulatively if they have to. That gives it a different structure in terms of corporate understanding. Now, drag in your example, if Bitcoin goes against you, that's not a drag because of preferreds, that's a drag because of Bitcoin. And in that case, if you are issuing preferreds to buy Bitcoin, if you're issuing shares of the preferreds, if you're paying out the dividend, and if you're issuing shares, if you're ATMing the preferreds to buy Bitcoin, the preferred instrument itself isn't the drag. It's the fact that you're buying an asset that's working against you.
No, what I think Chase and I are trying to get at is, so using the example I gave above, let's just say like Bitcoin's at 70,000 and it grinds up to 95,000 and you're ATMing along the way, which means that your annual interest obligation increases over time, but all of a sudden your NAV gets slammed in half, right? So on a relative basis, like that percentage of that interest obligation is a greater drag during those downtimes than the bull times, right? And so in the bull, so it's just, think of it as just leverage, right? In good times, in bull times, leverage works for you, but in bad times, leverage works against you.
Yeah, but that's still not drag though. That's leverage. So if leverage can work for or against, that's not a drag instrument. That is a reality of the physics of leverage, more so than it is a drag in the sense of the preferreds by themselves because of the corporate structure are a drag. If they are a drag, they should be a drag in all cases. It shouldn't be conditional.
Well,
that's my point.
Like just think of it as, again, leverage, right? Because the cost of capital should technically be lower than the Bitcoin's CAGR during bull time. Then on a relative basis, that drag is reduced. But during a bear time, the drag is increased. So whether you like the word drag or not, the debt obligation is ever increasing. And that's why there's a potentially bad scenario when Bitcoin's, or the balance sheet of these companies gets cut severely. Whether you like to use the word drag or not, like that could be a very catastrophic scenario, narrative-wise at least. But mechanically,
for sure. So, and I'm not trying to be pedantic. I'm just trying to be specific, and because I understand messaging is important. What you're referring to is what I call a crisis of scale. So if we have two ways that can play out in the catastrophic event that you said, which we both agree is an edge case, right? We don't see it collapsing like that, right? But also in theory, what if stretch and the preferreds gets so large and the dividend obligation gets so large that theoretically the obligation for paying that preferred acts as a, I don't want to use the term drag, but whatever. It acts as a weight, a drag, whatever you want to call it, on the corporation. That is possible, right? But the reason why I'm trying to differentiate between what we're calling it is that it is not as if the market is pricing in the drag from the preferred equities with the common stock. The common stock, just based on how it trades and based on what I understand, is a leveraged Bitcoin bet, and the preferreds are dependent upon it. Now, the whole thesis, kind of what you pointed out, is as it stands right now, they'll be able to issue equity to pay the preferreds, right? But also, even in the crisis of scale example that I'm using, in theory, they can issue stretch to pay stretch.
Oof, that would look really optically.
It would look bad, but they can do it. So cash is fungible, right? So let's just think about it. Once they issue shares of stretch and they get the capital from it and it sits on their balance sheet, how do you know what dollar goes to Bitcoin and what goes to stretch?
Yeah, and theoretically, it's a good trade because now you're issuing STRC at whatever that discount is. If Bitcoin gets cut in half, that's when you want to be issuing STRC because you're gonna, if you believe you're gonna bounce back, quickly outgrow or bounce back above the dividend rate.
No, but the issue
and that's why
the amplification ratio is really high when you have that bear market. So to issue more stretch during that time, you're increasing the amplification ratio. So I mean, like maybe retail doesn't care about that, but if you're like an institutional investor, you're saying like, I'm willing to like increase the risk on a thing that just got cut in half, and therefore like the amplification ratio just doubled. So I don't think that's a wise scenario.
It's not a matter of wise. It's like, can they do it? That's what I was getting. I didn't say it was wise. That's why I said, can they do it? Now, 2 points. And I don't want to be the contrarian, but it's just what I think. Amplification ratio, I'm sorry, it's kind of irrelevant in the case of how this entire corporate structure is going to operate, because as long as MSTR does what we think it's going to do, and as long as Bitcoin does what we think it's going to do, the amplification ratio is going to ebb and flow, but there's nothing that says it must be at this level in order for this to be successful. That's just my opinion. We can drill into that at another point. With regards to the preferreds and the corporate structure, that's why I'm saying, yes, we have to be mindful of how we conceive of it. A reflexive engine is something that can be self-perpetuating. That's kind of how I see it. Will there be instances in that engine where one instrument or one aspect of the overall function of the system will work less efficiently? Yes, but if you take a look at an engine, you can slam on the brakes or you can slam on the accelerator. That doesn't mean the engine is a drag in one case when accelerated in the other. The engine is the engine. And we're not trying to differentiate between drag and accelerant. Is kind of circular in that kind of a model, is what I'm getting at. So if it is serving the purposes of growing the net asset value of the company, which is directly servicing the purposes of backing the preferreds and giving the company more net asset value, more opportunities to issue further preferreds, more opportunities to go to the market with all kinds of other offerings that are Bitcoin backed, I'm not sure if it's functionally a drag, even with the interest obligation or the dividend obligation.
I guess sticking with your analogy, and it's funny because Robin brought up the car analogy. So if issuing STRC is the engine, and I guess you're saying maybe tapping...
Issuing STRC wouldn't be the engine in that case, but go ahead.
Oh, okay. It's not? What was the engine and what was the brakes in that analogy?
So Bitcoin is the engine. STRC is the action, is what we're using to feed, is fuel for the engine, right? So in one case, if it's drag, you're slamming on the brakes. In the other case, you're getting more Bitcoin. That's Bitcoin is the engine. You're giving more fuel to the engine. That's an accelerant.
Yeah. Okay,
That
so
that's what I was getting at.
I was going to say, if you give more fuel to the engine, but you accidentally click the car in reverse, then that would be like Bitcoin going down,
Sure, if I'm following.
right? Because
I mean, if you do that in an actual car, it might explode. But that's I don't know if the analogy then still holds with the car.
So have you guys ever seen like SpaceX show you the Raptor engines?
Mhm.
Like the very first Raptor engine looks like a bunch of things all duct taped together. And then there's like second generation, third generation, almost looks like a single cone on how elegant and efficient it is. Okay. So that's where I think MSTR is. Like, it has all these converts, it has all these different preferreds. So it's like kind of like zombie together. And then they're going through this second generation right now where they're paying off the converts. And I don't know what they're going to do with the other preferreds, but I think they're going to try to simplify the machine to make it more easy and streamlined. So that's why, like, out of all like the three companies you list right here, Strategy, Strive, Metaplanet, I'm still a Metaplanet fan simply because of how simple it is, right? They have like close to no debt. They're going to have prefers that they pay out of cash flow that they generate rather than ATMing in an environment that is low cost of capital, right? So regardless of the stock performance of Metaplanet versus Strive or Strategy as this moment, I think it is the cleanest narrative. And I think in the long run, a clean narrative, is going to do well.
it's the second cleanest structure to Strive, I would argue. And I would still argue that Strategy is the cleanest narrative because it's just, we are the biggest Bitcoin holder in the world. We always will be. That is what not backs, to Adrian's point, but supports our credit issuance. To me, that's like, we own the most Bitcoin is the best narrative still.
I mean, listen,
In
most
a
people,
Bitcoin-centric narrative, yeah.
I mean, listen, but most people don't buy off of one narrative headline. Like they'll try to dig deeper, hopefully a little bit. And when they look at that capital structure, it's kind of Frankenstein,
I loved
Well,
I don't
Adrian's. I loved Adrian's face because this was literally in my head. It was like most people I speak to literally have a one-sentence thesis why they do that, and if you ask them one question about why they think so, they usually don't have a good. Like, I think sometimes we are in like a small bubble, and you might be a deep thinker, Peter, and then like you go out like outside of your bubble and you ask like, oh, what's in your portfolio? Oh, I bought Nvidia. Like, why? Like number go like most people have no clue what they buy, like that's my general understanding.
That's right. That's totally fair.
So yeah, no. So what Peter is saying is valid in the sense of if you are a investor in the space and you're looking for a differentiated portfolio, and if you're looking for narratives to guide your allocation of capital, but people on the street, no.
No, but at the end of the day, though, like the people who move the stock, are serious investors who do the homework, right?
Yeah, people that move the stock are the ones that have enough capital to move it. I don't know if they're. Listen, at this point, and this is the weird thing about being in this space, I have sat down and spoke with enough individuals that are incredibly high net worth. I'm talking about tens to hundreds of millions of dollars. Yeah. And I have had at least half of them tell me that they know people that are just as wealthy as them that make dumb investment decisions all the time in size.
It's true.
Right. So we shouldn't. I think that what moves the market is capital, and what moves the market is position, and what moves the market ultimately is sentiment, and that's all going to guide capital allocations. But we shouldn't assume that the market is smarter than us or that we are dumber than the market. There's dumb people on both sides of this, because from our perspective, why Bitcoin isn't at 250K right now, it doesn't make any sense, right? From our perspective. Right. But the problem with that is we have people that have capital in size and positions in size that think Bitcoin should not be at 250K. Bitcoin should be at 70. It should be at 80. It should be at whatever. And it's not a matter of right or wrong. It's a matter of timing, sentiment, and positioning. And I think that circling back to what we talked about at the beginning of the conversation, to what Chase was asking, and to what you were talking about, Peter, and to what Robin, you were mentioning as well, Bitcoin is going to benefit from this structural change we're going through globally. It's just a matter of how much.
Yeah.
I don't believe in a hyper-Bitcoinized world, but I do think that Bitcoin is going to get some of the allocation of capital that's going towards the market as a whole. But I don't think it's going to serve as a rotation. I think it's going to serve just as a structural evolution. As the market gets bigger, Bitcoin's going to get bigger.
Yeah. Guys, I got to get going, but I do want to wrap it up on my end just with one comment in the regards that, as we mentioned in the beginning, or to your question, Chase, about what's Bitcoin's role in this post-AI world. I think AI is like an Ouroboros. You know what an Ouroboros is? A snake eating its own tail in the role of capitalism. So what I mean by that is, if you and I are in the same industry and I use AI more or more effectively than you do, I eat you at lunch. Okay. But that kind of goes up, up, and up to like one, if not maybe two or three top winners in almost every industry that requires AI. And so in that world, that's going to be almost like a post-capitalistic world where money is going to be either printed or redistributed in some sort of universal basic income, and then therefore the value of the currencies gets collapsed to nothing. But in a post-AI world, Bitcoin, in my mind, is energy-backed currency, right? And so that has like the true bastion of economic fungible value. And so while I don't know how long it'll take for us, for the rest of the world to realize that value, it's going to be a bumpy ride. But I think if you're positioned now, you're going to do well in the post-AI world.
Fair. I think like no matter what's coming, like if you are an active participant in the market and you kind of get what Bitcoin is, you kind of get what the treasury companies are doing, and you're using the tools and you're doing your research, and maybe get in here and there some AI trades, because I think AI and Bitcoin together is a very powerful combination. If you think about what those two paradigm shifts are doing to human society, that's a very, very powerful combination. It's also fun to see them kind of in the same time. If you zoom out from a time scale perspective, so I'm pumped. Like it's kind of you kind of have to be grateful to see those two amazing technologies and unfold when we are still so young as we are, and see it still do all our lives kind of progressing.
Well, what's funny about what you just said is that I actually borrowed against my Bitcoin to buy MSTR and NVIDIA in 2022. That's what I did.
Wow.
And so yeah, AI bull or not, Bitcoin is still the basis of my entire trade. So I keep my eye towards the future, yes, but I also keep my eye on what has facilitated this entire thing. So, and that's Bitcoin.
I
Awesome.
look at this. I'll just say I look at this very simply. Like, you're gonna want to have owned Bitcoin for at least one full cycle when AI takes your job. It's a little late to try to be buying Bitcoin the moment AI takes your job. You're gonna want to have been in it for at least a cycle.
I would pump it up to 2 cycles. Like I'm a 2 cycle guy. Like be at least like aim for 8 years. I like 1 cycle can be good, but like I think you're on the safe side with like at least 2 cycles, 8 years. That's for me the minimum. But yeah, 4 is already good.
Good.
I've got longer than 8, and let me just tell you, it still tests your patience at times. But it is definitely a long-term structural hold of mine that I do not see any event occurring that's going to make me want to sell my spot that I've held on for this long. Now, granted, if we hit 1 million, I might just delete my Twitter and you never see me again. But if even if I think it's at that point, it still makes more sense to leverage it as I have in the past versus selling it. Buy, borrow, die on my own small scale.
Really cool.
Buy, borrow, and live forever. That might actually be the future in our generation. We'll see.
Yeah, medicine is making a lot of strides. That is very, very true.
Well,
Let's live
next time
forever.
we'll talk about it. My last TradFi job was a wealth advisor, and there's actually things that you should know about it using estate plans and dynasty trusts, because if you hit those numbers, then you don't want to pay the government 40% on top of anything in addition to 30 million. So I know it may be some time between now and 30 million, but yeah, just position yourself well for that.
There's a lot of interesting conversations. Thank you guys so much for today. It was really interesting to talk with you, Peter, Adrian, Chase, today. And I think we will have a lot more interesting conversations. The next one will not be in 2 weeks, but in 3 weeks, because I realized in 2 weeks I will be in Prague, so it will be very hard for me to join in. So let's meet back in 3 years here, in 3 weeks here, and to talk about Bitcoin treasury companies, and hopefully also in 3 years. And yeah, see,
Okay.
we will be back in 3 weeks. Bye bye.
Thanks, guys.
Thank you.